The government have got this wrong. They've made it too hard for you to go and buy a home. In this video, I'm going to go through the financing conditions that govern your ability to buy a home and show you that we are operating in an environment of extremely low risk. Despite this, the government continues to go and hamper your ability to borrow to go and buy a home or property investment. I'm going to go through the specifics of all of the risks in our housing finance data and compare the lending environment of today versus average and use RBA research and our lending body, APRA, to show you exactly what financing conditions are like to prove that the government have got this wrong. If you're interested in property investing or the economy in general, this video is for you. Hi, I'm Reedham Syed, ex-Treasury economist, founder of Confidence Finance, and for the past 10 years, I've worked with thousands of property investors to help them grow, build, and scale their property portfolios. So let's go through it. Here, I have this amazing chart by the RBA that shows current financing conditions and compares it to average. Obviously, the number one thing with financing conditions is the interest rate. How much is the price of credit? And really that drives a lot of other things. It drives how much you can borrow, it drives whether you want to take on credit, it drives whether you want to buy a home in the first place, it drives the cost of money. That's what this shows, and it shows the current cash rate versus average way out here. The blue is where we are at the moment, the green is average. We got the 3-year government bond rate, which is kind of where fixed rates sit. It's based off this. Again, well above average at 3.9%. This chart is a little bit old. It's come back down to about 3.6% today. The outstanding variable mortgage rate, 6.5%, while average is somewhere in and around that 3.5%, 4% range here. Despite all of this, credit growth is a little bit above average, sitting around 5%. This is largely because we're sitting in an environment where house prices are going up across the country versus about 18 months ago when house prices were falling, and that's when credit growth was a little bit low. We've got a whole range of other indicators here that showcase how credit conditions are going across the Australian economy. But what proves that housing finance conditions are a little bit too restrictive at the moment is when you look at the risky type of lending. You know, high interest only loans. Are so many people borrowing with really low deposits at the moment? Are people stretching their serviceability and going and taking on loans that they can't afford? The government measures all of these risk factors and releases the data every single quarter. So let's go through some of that data here. We can see that the type of lending is going to investors. New lending to investors is increasing, and yeah, it's pretty sharp. In WA, it's up 140% in the last 18 months, while in other cities, it's up 30-40% over that time period. So investors are making up a bigger share of the market. But banks are continuing to lend prudently as volumes have increased. The reason why volumes are increasing is all related to the benchmarking impact. It's because the housing cycle is on an upward trend over the last 12-18 months versus the downward trend it was on when interest rates first began rising. So of course you're going to see an increase because it went down and now it's going back up. But when you compare this period to this period and skip the middle period, so 2024 to 2021, you're going to see credit growth and credit conditions broadly similar, but it's showing big increases because there was a big roller coaster down and now back up. So that's why you've got some of these data showing increases on a percentage term because the base effect is pretty low here. Let's look at a few of the risky metrics here. So interest-only lending. Interest-only lending became really topical a few years ago when it made up nearly 40% of all loans, and that really caused some worry. And the APRA, the governing body, came up with a cap on interest-only lending. This was in 2017, actually. They came up with a cap on interest-only lending, limiting it to 30% of all new lending. Today, interest-only lending is increasing a little bit as a function of property investors seeking more loans, but it's sitting below 20%. So well below that 30% benchmark, not even near it. And that suggests interest-only lending is not a risk at all. The reason why the government is a little bit concerned by interest-only lending is because if people are taking out loans and they're not paying them back, it adds a little bit more risk to the system. Also, interest-only loans actually have a trigger point. After 5 years, they move to principal and interest repayments, and they go from this type of repayment to a repayment that's about 30 or 40% higher. This increase in repayment can cause a little bit of an issue because borrowers may not be prepared for it, and it creates a little bit of a risk to the system when so many borrowers have a big increase in their repayments at the same time associated with the expiry of their interest-only period. So that's why they measure interest-only period, and it's viewed as a risk metric. The next two metrics to look at are serviceability-based metrics. So how large of a loan are borrowers taking out relative to their income? This is an obvious risk point. If too many people are taking out loans that are too big relative to their income, it creates stress. If people take out very large loans relative to their income, when interest rates change or even in their day-to-day cash flow, they're going to have more stress associated with it. A larger percentage of their income is going to go to mortgage repayments, and those borrowers are typically at most risk in changes in circumstance. If one person loses a job, for example, if the economy changes, if interest rates go up, it could be a whole host of things. We've seen that with COVID. Life circumstances and the economy can change, and you need to ensure that housing credit, when someone's taking out a loan for 30 years, you want to make sure that they can repay it all the time. Those that take out bigger loans relative to their income, they're a little bit of a risk metric. So how's that data looking? A couple of years ago, we had a quarter of all borrowers, a little bit less than that, of all borrowers borrowing about 6 times their income. Nowadays, the data has the figure at 3%, down from up above 20%, down to 3%. This is the #1 metric to showcase that lending conditions are simply too tight. If you want to go and get money to buy a house that you feel like you can afford and that you need to, especially if you operate in Sydney because house prices are at their peak, and you want to go and get money to go buy a home that you feel comfortable in affording, and you may have pay rises down the line, you have no chance of getting enough money to go and do so. This is shown in this data. If a couple years ago, everyone was able to get these big loans, and now nobody can get these loans at all or even close to it because the serviceability criteria is so tough, then that restricts your ability to go and finance a home that you want. The problem is prices are still really, really high, and your ability to get debt has come down, which means you need more capital to go and fund that home. You need more savings. Put in other words, you need parents who give you bigger gifts, and you need parents to come in and act as a bank of mum and dad. Problem with this is it's entirely unfair. Some people do not have that. Some people don't have access to parents that are going to give them big gifts or big guarantor loans to go and buy that home. Those that do, those are the ones participating. This is what happens when you make credit conditions unnecessarily tight. You block access to credit, which means you block access to housing, which means you block access to wealth creation, and you create a have and have not society. This is the problem the regulators need to understand. Restricting access to credit to those who want to and are able to go and afford a home for no benefit to financial stability, which is what their own data says, is creating disruptions in the Australian economy that frankly is un-Australian. We should not be creating a society where you do not have access to opportunity, and that is what this credit data showcases. Yet we still have the regulator coming out there being like, our serviceability metrics are appropriately set. If they are, then you have completely failed yourself a couple of years ago. If a number around 3 to 5% is appropriate today for high DTI loans, how is a quarter of all loans appropriate 2 years ago? It doesn't make any logical sense. And this level of change and yo-yoing has disruption impacts to Australians simply trying to buy a home. It's pushing people into homes that they don't want. And it's unnecessary because there is no financial stability concerns associated with this. APRA, if you're listening, take a look at this data. It's your own data. This is your quarterly data from your website. Your conclusions simply do not make sense when you're looking at it this way. Lastly, we have loans with small deposits. So what's the number of loans that people are taking when they're only providing 10% deposits or 5% deposit? APRA go and measure this every quarter to make sure that we are providing enough collateral, enough of a deposit when purchasing a home. The reason why they look at this is in really worst case scenario. If things go really bad, what they need to ensure is that the banks don't get themselves in big trouble with falling asset values and having really high exposures to property assets without much collateral. So we don't have much of a problem here at all. 7% of loans, something really, really low. Looking at it very closely, it's around 8% today. It's a pretty low number not a risk point at all. It's never really been a risk point in Australia, perhaps because Bank of Mum and Dad is so big in Australia, providing more capital and ensuring that people are providing bigger deposits on purchases, but this isn't a risk point either. So when you take a look at all of this, and take a bird's eye view, what do you see? You see number of interest-only loans, pretty low. You see investor lending, pretty high, but that's a little bit cyclical. You see credit growth doing okay, but nothing of a concern. You see high debt-to-income ratio loans, so high serviceability loans being very, very modest at the moment. And you see small deposit loans not being much of an issue. Basically, you see tick, 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 tick. Our financial system is very, very safe. That sounds good, but it has consequences. It's too restrictive at the moment, and it's appropriate for the lending regulators to begin looking at serviceability benchmarks, particularly for first home buyers, and allow them that extra little bit of lending that they need to ensure that they can go and get the money to go and buy their home. That's what this data is showcasing. And it shows that we have a little bit of a problem and that the government has got their policy settings wrong.